Hey, what's going on, everybody? It is Aaron Trevino here, and we have a wonderful guest from Dallas, Texas. We have Ben. How you doing, Ben?
Hey Aaron, doing great. Thanks for having me. Glad
Yeah,
to be here. It's a little cold outside, but been pretty busy week so far. So happy to be here talking to you.
yeah, that's right. That cold front just blew in, but I like it. It's got me in a good mood.
Yeah, always happy to talk to another Longhorn. There's too many Aggies up here in Dallas, so it's always good talking to another someone else with burnt orange blood.
Yes, sir. Yes, sir. I have to represent.
Yep.
Yeah, but no, it's great to have a fellow Longhorn on. So for those of us who aren't familiar with you, Ben, would you introduce yourself?
Yeah, sure. So my name is Ben Mandelstein. I'm 27 years old, from Austin, Texas originally. Went to the University of Texas, studied economics there. Got a job at a big tech company in sales straight out of college, which was what brought me to Dallas. They had a really good training program, about 6 months. But I started making pretty good commissions right off the bat, and really wanted to figure out a way to have my money work for me. I know with sales, it fluctuates quite a bit. Your good years, your bad years. So, when I was fortunate to get big commissions, I was trying to figure out what should I do with the money? How can I make my money work for me? I had mutual funds and stuff at the time. Didn't really like it. I'm someone who wants something tangible. So, being from Austin, pretty much my whole life, I saw how Austin was exploding without really knowing what I was doing. Started putting offers on fourplexes in Austin. I got my first deal under contract, pretty close to the domain. It was a fourplex. Bought it, and it was, I think, early 2017 for 372K. So obviously nothing like that exists today. Austin's exploding. At the time, it was a slightly rougher area, but everything around it had already kind of gentrified and gotten better. So literally bought, was under contract on my fourplex, had no idea what I was doing. My sister bought me a book, Millionaire Real Estate Investor, for Christmas. And while I was under contract, started reading that book. And I think that's where everything started really making sense for me. Kind of fell in love with it. It happened, I ended up getting a good deal. So even though I didn't know what I was doing, it worked out. But then, yeah, got that, kind of fell in love with it. I tried to do Airbnb out of one of the units, since I was claiming owner occupant at the time. Um, that definitely an interesting experience. My first tenant was a rapper for South by Southwest. He posted pictures on his Instagram with just say some illegal stuff in the unit, and left it in really bad shape when he left. So that was a kind of a rude awakening to my Airbnb. But since then, you stopped doing Airbnb, waited the year or so, and got a regular tenant in there. Tried again at Airbnb. I did a duplex in Dallas, in Bishop Arts area. So if anyone's familiar with DFW, and kind of wanted to this time actually strategically make it for Airbnb. So built it out. Did a one room that had two sets of bunk beds, full, and then another room just regular bed. But my goal was high occupancy. Um, so went really well at first, but had a lot of things that I wasn't necessarily thinking about. Jumped into that one, not necessarily knowing what I was doing. But yeah, since then I've grown a lot. Now I'm working on getting my first apartment complex. So I've got 8 properties I own outright right now. I've got 3 other partners I work with. And we've been actively looking at probably about 20 different apartment complexes so far, working with a really good company here, DGRE. So I learn from my own mistakes and kind of jumping in blindly. It's better just to find somebody who's successful, who's, has a really good track record for success, copy their model, work with other people, get a mentor. So that's exactly what I'm doing as I jump into apartments. I definitely can't do the same thing. I was able to, take that risk on the smaller scale. But, not when you're doing a $10 million deal, especially when you're working with partners. You need to definitely know that you know what you're doing. You have experts who've done it many times. You've been able to, your partners that have gone through the whole entire process from start to end. So that's where I'm at right now today. Super excited about it. When I started with that fourplex 4 years ago, it was really just something passive to do for fun. And now I'm really trying to figure out how I can make real estate my full-time job, and kind of transition out of the big tech.
Yeah, absolutely. I'm just curious as well. I know you'd mentioned how you had those commission checks, the money was coming in, and you thought, hey, where do I put the money? Was there any particular moment when it finally dawned on you that real estate was a way to go, or this particular deal was a way to go?
Yeah, I would say my original goal was just looking at areas that I thought would gentrify. So at the rest of the city, got improved and it's really nice. And there's just like maybe one little pocket that hadn't quite gentrified. So looking at the path of progression. So that was the initial analysis I used. And then one of my coworkers or at the large tech company I work for had a spreadsheet that he sent me. So I was comparing single family houses to duplexes to fourplexes, and it was obvious the fourplexes had much better cash flow. So off the bat, when I got my fourplex, it was cash flowing about $1,200 a month, which compared none of the single family houses are cash flowing at all. So I wanted something that would appreciate, high chance for appreciation, but also would provide good cash flow. Um, and then also like learning about the tax benefits. It wasn't necessarily something I knew right away, but it's really awesome what, I'm able to use my depreciation of properties to offset my W-2 income. And I've been fortunate enough to get some nice tax returns in the last couple of years and hope to get another one here for the 2020 return. So yeah, I mean, I think being an economics major, the stock market just moves so quick. It's so hard to understand all the financials about a company. Whereas with real estate, you really can truly see the bones of a property. You can understand the neighborhood. You can understand the trends in neighborhoods. And because of the barriers to entry, you're actually able to take information and make smart decisions based on it. Where the stock market, as soon as there's a news article published, the market reacts instantly. So that's what I really liked is finding, being an economics major, finding inefficiencies and how to profit from those inefficiencies.
Absolutely, that makes a lot of sense. And you said something interesting talking about you use the words depreciation in W-2s. Could you kind of elaborate on what depreciation is in this context?
Yeah, absolutely. So typically a property would depreciate, for a longer term life cycle. In 2017, we had a new tax plan that was implemented that actually allows investors to depreciate a much larger amount in year one. So for either duplexes or fourplex, you're typically not going to do a cost segregation study. You're typically just going to take a kind of a rule of thumb, usually about a third of the property's value, and you can write that off. And then also all of the rehab that you do, if as long as it's deemed cosmetic in nature, you can also write that off in year one as well. So while the property's going up in value, while you're getting cash flow, while you have great leverage from the bank, interest rates, are in the 3% range right now for single family, some even in the twos. Um, you may only have, say it's a 400K property, you may only have 100K in it, but you can claim a third of the property's value in depreciation. So you may claim you're, basically on paper writing off 133,000 when you only actually even have 100K in it, and the property is probably, for in my case, duplex or the fourplex I bought for 372. Today's market's worth probably about 550. So I've depreciated, a large chunk of it already. Basically all the rehab was cosmetic in nature, so we wrote all of that off, a third of the property value. While it's appreciated, we've been able to raise rents, and it's really been a game changer. So I think for me, I've always just focused on my net worth, not so much like my bank account or having nice things, but what can I do every week to kind of figure out how can I increase my net worth. So that's been my focus.
Yeah, absolutely. You touched on something interesting there. Could you kind of give us an explanation of the difference between your bank account versus what net worth is?
Yeah, absolutely. I think there's a trend, or I don't know, a lot of people our age typically just focus so hard on getting that raise at work, getting the extra $5,000, $10,000, while they're maybe leasing a BMW or Audi, or nothing wrong against having nice things. But they really focus on work, and then as soon as their salary increases, they increase their life, their spending, they increase going out to eat more often, they upgrade what apartment they have, or they get the nicest house they can possibly afford, while they're keeping their net worth pretty flat relatively. So for me, I know especially in sales, I can have my good years, I can make commission. But the one thing is my net worth should always be growing, and especially learning about how real estate can get you anywhere from an 8 to 20% return if you're smart with your money. I want pretty much all my net worth in real estate, and I want my net worth growing at that rate. So ultimately, your net worth should be making a lot more income than you could possibly make from any W-2 job. And that was ultimately the goal. There's also a tip that was out of the Millionaire Real Estate Investor. So that was one thing I picked up while reading the book, while I was just really getting started learning and kind of getting addicted to real estate.
Yeah, absolutely. It's about the money management aspect, and it could kind of lead into talking about the exchange of time and money.
Yeah, absolutely. Yep. Yes. If your net worth's working for you, you don't have to trade your time. So, at a job, as you go to be an executive, you're going to be putting more and more time in. And ultimately, at most W-2 jobs, you're going to be capped out at a certain point. There's no cap of how much your net worth can make for you, as long as it's growing. Typically, once you get your net worth in the millions, if you have that earning at a 15%, say you have $1 million net worth, all earning 15%, that's 150K without you doing anything. So that ultimately was my goal, is to hustle really hard, do whatever I can to get that net worth, and then my net worth will grow for me. So I view in your 20s, that should be everyone's focus, is really trying to do anything they can to get their net worth up.
Yeah, absolutely. Maybe someone's in their very early 20s or just getting started. I mean, you've been able to do a few deals and be able to have a good perspective on the market. What would you recommend for them?
Yeah, it kind of depends on what your goals are. So typically, if you're going to be doing it yourself, there's going to be some growing pains. So I'd say find a RIA, find other people who've been through the whole experience, and find mentors who you can talk to about it. So for those in your network, feel free to reach out to me. I still have time. I help a lot of my friends. I've got a lot of my friends start in real estate. But if you do, there's nothing wrong if you do want just a better passive return. I mean, in that case, a syndication is a great model, because instead of going through those learning pains, instead of having to learn everything and build a team, find the right manager, find the right contractor, you're able to find an expert who has all those systems in place and that team already. As I've grown, I've seen a lot of people actually sell off their single family home rentals and just find really good operators and apartments and other syndication models. And basically, they're able to get those 15%, 20% returns without doing anything. So it really depends on what your goal is for someone in their 20s. For me, I loved real estate, and I knew I wanted to have an active role in it. So while we have passively invested in an apartment deal, I really like being the active person, hustling, and learning as well. So uh, yeah, it just really depends on what your goals are. But no matter what, you want to find expertise and pair with them to avoid a lot of the costly mistakes that you can make as a newer investor.
Yeah, absolutely. It makes a lot of sense. And I mean, at the end of the day, it's one thing to read about something. It's one thing to hear your friend talking about it, but it's another thing to actually go in and do it, right?
Absolutely. Yeah. I mean, the podcasts are great. Bigger Pockets is awesome. I'm sure this podcast is really helpful, but it is another thing when you're actually there, you're actually talking to contractors, making sure that they don't run off with your money. So we've definitely had some great learning experiences that have been scary as well. Luckily, every deal we've done has been profitable. Appreciation has helped with that too, but we've definitely made some big mistakes. Rehabs have taken longer than they should have. But now we have a really good team in place, and that's before I ever started partnering with people from out of state. Definitely wanted to be confident, so really started just me and my wife, and then once we've had our systems in place, had a really good property manager, have really good contractors, a good understanding for what works, what doesn't work. That's when we started partnering with people in other cities. So really, I like Dallas a lot. I think you can still buy cheap deals. I look for 1% rent to value on the duplexes and like the fourplex we got, which I don't really see at all in Austin, just from what I've seen. So personally, I like Dallas a lot because you can still find people that don't necessarily know what their house is worth. You can find those motivated sellers um, that you're able to buy for 70-80% of what it's worth.
Yeah, absolutely. That makes a lot of sense. And you mentioned something interesting as well, talking about a big fear that investors have is they get into this rehab, they get into this deal, and it takes them longer than expected. Is that mostly
Mhm.
because of maybe not taking into account certain materials, or what do you think?
Yeah, I think when you're looking for the right contractor, it's a really tough thing to do. That was, I think, one of my mistakes. Is I just went for the cheapest person. So I got, went to bigger pockets and found different referrals from other investors, and ultimately just went with who had the lowest quote. But that person wasn't as motivated to finish, so they had a bunch of different jobs they're running around. I'm always having to hassle with them. For me, communication is huge. So I might pay a little bit more, but to have somebody who will respond, to have somebody who sets realistic timelines, that's way more important. Especially once I actually started working with partners, because it's one thing to have the construction person or the contractor delay my own timeline. But if I set expectations for my partners, I need to also be able to trust the contractor that they can meet the same expectations that I set. So that's been a huge thing, is basically learning from that mistake of going with the cheapest person, and finding people who I can trust. And then at the same time, learning a lot about the whole entire rehab process myself. That way I understand what materials cost and what labor should cost, versus kind of just ballpark numbers, and kind of trusting what someone else tells me. So I think, getting lots of quotes, understanding material cost, understanding what labor cost should be, and then, yeah, finding somebody who'll communicate, and, finding someone you trust is huge. Because, like, I'd say one of our deals, I think my early mentality was just keep buying stuff, and keep trying things, and I would learn from my mistakes. So the first deal was a fourplex. It wasn't really a whole lot of mistakes, and it worked really well for appreciation's sake. Then the second deal, the one in Bishop Arts, got into Airbnb. I thought I was smarter than everyone else, and I could, make a 800 square foot unit that could hold a group of 14 people by putting bunk beds in it. So it did get to, it did work really well at first, but I didn't think of how hard those groups would be on the property, and the maintenance, and how hard it was to get a maid who's willing to clean up after that many people. And then my next one was, we had a really good deal on the property. It's actually across the street from the duplex we live at today. But it was basically a house that could have been torn down. We decided to keep it up. It's a single family home. It was zoned duplex, and we basically like built it from scratch pretty much. So worked with that same contractor who was really cheap, and it was definitely way above his head. He hadn't really worked with the city a lot, so dealing with development, dealing with all the permits that were required. It took really really long time, to the point where at one point, we had paid in advance. Basically, we had done the foundation, we had completely, demoed everything, kind of prepped it, cleared out. That when we bought the house, there's a ton of all kinds of garbage and stuff. It was kind of like a hoarder house. But yeah, we probably had only done like $20,000 worth of work. We'd paid him about $57,000, so we were ahead on payments of like 37,000. While he was going to the city and trying, every time I talked to him, he'd say, "Oh yeah, the permit should be approved next time. We got to tweak this little thing. Oh yeah, we got to do this to our plans." And then, at one point, he just stopped answering me completely. So I was calling him, um, yeah, just nonstop, like once a day, texting, calling, trying to get a hold of the guy. Um, and because I'd actually ordered some materials to his house one time for a different project, I had his address. So I was actually driving to his address just to go try to, talk to him. Um, and he randomly, finally responded and called me. And, I told him, hey, look, I know, you've had a lot of issues with the city. In Dallas, it's really tough working with permitting. You got to go and wait at like 4 a.m. in the morning, wait in line. So I think it's changed a bit since COVID, but at the time, that's what you had to do. If you wanted your plans reviewed that day, you had to go there, wait in line. So there's companies that's all they do basically is get plans done for people. So I'm competing basically with all these people who have an entire system in place. They've got one person who goes and drops off all their plans in the morning. And if you don't get there at like 4 a.m., you're not going to get your plans reviewed. So, um, you know, I basically took over that element of it, kind of became the GC of the job, got my own subs for the rest of it. So I learned a lot. I got my GC certificate for what it's worth. I don't plan on being a GC for other jobs. But yeah, I learned a ton. But yeah, it ended up taking a total of 18 months, which is ridiculously long. The first like 9 of those months was just, we did all the initial work and trying to get our permits approved. Um, Especially with the wrong contractor who didn't know like exactly what the building plans were, or what the building code was for 2019 at the time. So it worked out because we bought the deal significantly below market value. We paid 145 and the land value itself was 183. But yeah, we went over budget. But now we have it. We got tenants in both sides. It's worth, it appraised for like 380 about 6 months ago. I think it's probably worth about 400. So we've made about 80K. It's a pretty solid rental. You've got a good interest rate on our loan. It's in right near Deep Ellum, so it's definitely a good appreciating area to own. But yeah, I just learned so much about like having the right person for the job. Not just trusting them, blindly going in. And then yeah, learned like what materials should cost, because I got to the point with that contractor that I was only paying materials because we'd gone so far ahead on other payments. So it's paying little tiny increments of labor, but mostly just paying materials. So I was going with them to Home Depot to make sure they're getting materials just for my job and not trying to skimp other ways. And then I ended up hiring all the trades myself. So I ended up hiring the electrician. I ended up hiring the HVAC person. Um, Ended up hiring the plumbing person myself. And now those people actually ended up being really good. Those people I use today. So yeah, I learned a ton in the process. But yeah, as a new investor, it's not always good just to try something because you'll think you'll learn. And sometimes just because a contractor tells you, oh, it'll take 6 months, if you're not, if you don't know they have a track record, especially if that contractor hasn't done that level of project before, it can easily take much, much longer than that. So the biggest thing I learned is, what amount of time I can spend on a project to have the best return, and trying to kind of handpick other deals where it's mostly cosmetic in nature. And if it is more structural stuff, I need to have a big ROI. I need to have a big benefit of doing it. You can't always just do something to learn from your mistakes. At some point, you got to stop making mistakes and actually, kind of get your systems in place.
Yeah, absolutely. You mentioned something about, kind of talking about the processes, right? You would show up frustrated because, someone else got there at 4 o'clock in the morning. They have a whole team, they have a whole system. What sort of processes or systems, what would you suggest that people can implement, from the beginning?
Yeah, that's a really good question. So I think as far as just different systems, it really depends on what model you're going for, whether you're fix and flip or buy and hold. For buy and hold investor, I think it's finding a really good property manager. I love my property manager; she's great. I've gone through a couple different ones in my Austin property. But yeah, the one I have now actually lets me use her MLS access. So which I love, so I can see all the the sale data live. So whenever I'm going to look at like an off market wholesale deal, I can instantly look at comps, which has been huge. But yeah, just having a team of people you can trust is really important. Now I feel like I really have good contractors that I can trust. And then I think, yeah, ultimately with specific to contractors, yeah, making sure you don't get ahead of payments is a big thing I learned. But yeah, as far as systems, it really depends on what you're doing. Um, yeah, I think being conservative in your underwriting, kind of overestimating rehab, expecting that there's gonna be a lot of maintenance costs, all those things, and just being really kind of picky about which deals you get. I think a lot of new investors only look at rent and they look at purchase price, like, oh, this deal cash flow is great, but you don't know necessarily how much maintenance you're going to have when you're first taking over that property. But yeah, I'd say like that's why the RIA clubs, finding, networking with other investors, learning from the systems they have in place. I think I hear on the Bigger Pockets podcast, they talk about like rock stars, no rock stars. So if you can find a good, successful investor, they definitely have good contractors. They have systems that work for them. So instead of trying to reinvent the wheel, instead of trying to learn the hard way, just finding other successful people is definitely the best way to go.
Yeah, absolutely. Like anything else, it's just kind of a matter of who you can call on and who you can trust, and who you know they can get the job done for you.
Yep, absolutely.
Yeah, definitely. Well, I'm just also curious, kind of, yeah, a big thing that people talk about are permits. Could you kind of
Mhm.
explain, what a permit is and what it means in this context?
Yeah, so it just depends on the type of job that you're doing, depends on the city you're in. Some cities are much easier to work with than others. But for doing large jobs, like whenever you have an addition, you have to get a master permit for the job. So they're going to look at your building plan. So there's, all different types of drawings that you basically have to submit. And they're really going to look for any tiny little error that you have, and they're going to send you back. So it's really important to have, a good architect, to have, good people doing your drawings, making sure they're up to date on current building code. And then there's other permits that are like trade permits. So for instance, plumbing or electrical, HVAC, those are much easier. Any good plumber, any good electrician, can easily pull those, and that's a lot easier. But getting the master permit on, if you're doing any kind of addition or major project, that's where a lot of the complexity comes into place. And personally, I like to do cosmetic jobs where you don't have to pull permits, because that makes it a lot easier to predict how long it's going to take. It keeps your costs down, keeps from having to get different inspections at different points. So it really depends on what the job is and what city you're in. Dallas is really tough to work with on permits, but for instance, Garland, just outside of Dallas, is much easier.
Yeah, it's kind of funny that, I mean, the DFW Metroplex is humongous, but kind of, from the outside looking in, people wouldn't know the different nuances of, Dallas
Mhm.
this, but oh, Garland does this, right?
Exactly. Yeah. That's where your RIAs and networking with other investors can really help you. And I think, if you need to pull permits, you should work with a contractor who pulls permits all the time and does that type of project, versus working with someone who mostly does painting and, maybe some countertop and tile and more cosmetic. And then they try to go and learn while they're doing your project. You never want that. So you want to make sure they've done similar types of projects. Probably interview their past customers, they've worked with. Did they meet their timeline? I think that was one I did with the contractor who kind of messed up. I went and saw some cosmetic things that he had done for other investors. But I didn't really ask a whole lot of questions on like how timely were they, and how responsive they were. Um, Now, before I work with any contractor, before I'd ever pay them a lot of money in advance, definitely make sure that they're reputable, they've done good work for other people. So now I typically go to other investors I've networked with and say, oh, who's a good framing guy do you use? Who do you use for your cabinets? And typically other successful investors know good people who are reliable. It's always hard for a new person who doesn't have connections to find the right team of contractors.
Yeah, absolutely. It's always great getting those referrals. Especially if you're coming in fresh, you're coming in new into the industry, and it's great to have someone that can kind of point you in the right direction.
Hmm. Absolutely, yeah. So,
Yeah, absolutely. So I know you talked a bit about how you got started, but what are you doing now, and what are you looking to do in the future?
yeah, so what I've realized as I've been partnering with other people is I really like to be the active person, and scaling to doing larger deals. Typically, just the numbers make sense for the amount of time you have to put in. They can make much higher annual revenue, a much higher cash flow. You're able to, being an economics major, instead of single family through through 4 units, appraises based on comps. Whereas I really like how apartments operate based on net operating income. So if you can make that business run more efficiently, you can directly increase the value of that business based on the cap rate. So I like the way that apartments are structured. I like how it's data driven. It's not a guessing game. It's not a business where you go in and like, what works? Oh, well, I could try this or that. But yeah, you basically copy what other successful apartment investors are doing. You implement the same model. When you buy the property, you put a bunch of capex. You do that to raise the rents, make the units nicer. You try to decrease expenses, and that drives up your NOI. And then after 4 or 5 years, you sell it. So I really like apartments. There's so much thought about specifically what upgrades to do. There's tons of data out there on what other people have done to achieve those rents. And you're very specifically trying to figure out when's the best time to sell to have the highest average annual return. So with a lot of my other deals, I plan to just hold them, for until I want to sell them. But I don't really have any intention on selling. And when I buy them, I just plan, oh, they're great, passive income, and something I can just hold on to for a while. It'll increase in value over time. Apartments, it's so data driven, and they're so focused on maximizing your average annual return, which is really hard to do at the level of like a duplex or fourplex. So I'm fortunate enough, I've networked with a lot of different groups. There's different kind of masterminds, mentorship programs. And there's one group in particular I really liked, just the people who were involved in it. It's Darwin German Real Estate Investing here in Dallas. So they've been syndicating since 2003. Before that, they were in apartment management. So they've been through, the Great Recession in 2008. They've had a property a couple of years ago that was hit by a tornado, ripped the roof off. So they've seen it. They've been through all of that. They know what works, what doesn't work. They have all of their contractors because they have the scale. And they have, I think, about 12 properties in DFW. They've got a couple in Hawaii. They're closing a fractured condo deal right now in Waco. But yeah, they have their own in-house property manager. They have their own in-house attorney. They have their own bookkeeper. So they're not big like a corporation. They have I think that they're lean enough to where most of the money is going directly into the investment. But at the same time, they're professional enough. They have all their systems in place. So um, I really like them because they were very honest about their returns on all their deals. They used to, before COVID, they'd have monthly kind of meetups where all their passive investors would come. And just talking to, I probably went to like 5 or 6 of their meetings before I really talked to the founder, Darwin, and his team, but just talked to a lot of other people there. And, they were super happy with the returns they had gotten. They'd invested in deal after deal. Basically, after they invested with Darwin, they didn't really look elsewhere because they liked how Darwin operated. So they would basically invest. As soon as Darwin had another deal on the table, they would put their money with him. So we invested in one of their deals in Fort Worth. That was a 2018 build. It was a 212 units. And they bought it directly from the developer for 135K a door, which is pretty crazy to be able to buy an A-class property for just $135 a door. I know in Austin you're seeing rates like probably for a new build like what, 230, 250 a door.
Yep.
Um, so yeah, working with them, they have the expertise. They have an in-house broker, Julian, who I've been working with. So we've been underwriting lots of properties. Actually, this morning we went out and looked at one that looked really good. That was an off-market deal in Arlington. Just from doing a drive-by tour, looking at the outside, it looked pretty solid. We met the broker and toured a couple of the interior units. It definitely looked a bit rougher than we thought, so kind of adjusted where we thought our numbers would be. But yeah, we've been underwriting many different deals, trying to be really picky about one that our conservative underwriting model will predict, at least about a 14% average annual return for our passives. So yeah, I've been networking with a lot of my friends and family. I have a lot of people who'd like to partner with me, but I think the syndication model just makes a lot more sense. With an LLC, you're really kind of married to that person. You have to use the same structure on every deal. So while I have 3 LLC partnerships at the moment, and those are all partners I know I'll do multiple deals with. I've got 2 of them are 50-50 ownership. So every deal I do, I have 50% ownership. My partner has 50%. One of them is 33, 33, 33. So it doesn't matter, how much work I'm doing, how complex the deal is, how I found it. Every deal has to basically be structured the same way within the LLC. Whereas the syndication, you have one big giant property. You have a bunch of people invest in one deal. You make a company. You have the LLC for that one property. But then as soon as you're done, as soon as you've gone the full cycle, 3 to 5 years, you sell, everybody gets their money. So you're getting the same cash flow, you're getting dividends, every month. But then whenever they sell it, you get equity out of the deal plus profit for, how much more they've sold over, what they bought it for. And then you can go your own route. So, you're not tied up to having that LLC where you have to have the exact same terms on every deal. And like for example, for every LLC, I'm paying about $850 to my CPA to file our annual business return or annual tax return. Where that's at the whereas with the LLC, you have the scale of maybe there's 30, or I'm sorry, with the syndication, you have 30 to 40 people maybe investing. So all of those kind of overhead costs get spread out, and it's just in my opinion, a much more efficient model that can really make more money for all the passive investors.
Yeah, absolutely. So, when you're talking about what would make money for the passive investors, or even just looking at a return, is there a certain range or threshold you want to meet to say, hey, this is a viable deal?
Yeah, it's a great question. So really for us, we're looking for, try to use really conservative underwriting. So lots of different syndicators underwrite completely different ways. So for us, we expect the cap rate to go up 0.2% every year, which actually decreases the value of the property. The lower the cap rate, the higher the valuation. So cap rates are very low right now. We underwrite, giving us the safety net that cap rates could go up, in the next 5 years or so. So we want to make sure we're all of our assumptions are very conservative, and if everything conservative still gets us that 14% return, then we have confidence that it'll work. We always like to, the group or Darwin always tries to underpromise and overdeliver. So I think their historical return has been 30.4% on all their deals since they started in 2003. Now, that being said, a lot of the deals they did were from 2012 to 2020, and everything's done super great, and properties have all risen in value. So while their historical returns are about 30.4%, most of their projections historically were maybe 18 to 20%. Today's market's definitely tightened up, so you have a lot of groups syndicating. But yeah, we're really picky on what deal we do. We try to use conservative assumptions, and then finding something even with conservative assumptions is going to underwrite for at least a 14% return for our passive investors. We've looked at so many deals that underwrite, and other people are buying them. Other groups are buying them. They're underwriting for 6% return, 7%. So there's 2 main metrics. There's the cash flow. So if say someone invested $100,000, what would their cash flow or basically dividends be? So you have average cash flow for the time you're holding it. So we look for something that's going to cash flow usually anywhere from like 7 to 10, or maybe 11 if you're lucky. And then something with the total average return over the 5 years being about 14% or higher. But of course, those are the projections. Nothing certain, but we try to be conservative. That way, we can overachieve the projections that we have.
Yeah, absolutely. It sounds like regardless of how you're underwriting the deal, you kind of want to take the conservative approach.
Absolutely, it's reputation's everything. So if you know doing one deal is not, if you do one deal and you promise everything and it doesn't go well, those people aren't going to invest with you again. And it's going to be hard for you to get another deal under contract. When you go to get your financing, the bank's going to look, okay, how did you perform on your last deal? So it's very important to perform well. It's very important to set realistic expectations to your passives, because ultimately you want them to keep investing with you over and over and over again. You want them to tell their friends and family. A lot of the way people find out about these opportunities is word of mouth. So if somebody's really happy with their return, they're going to tell their family. That's going to bring more investors in. And a lot of people are happy with like a 14% return. The stock market historically is anywhere 7 to 8% average. So if you can have a nice tangible asset, it's not going to fluctuate quite as much as the stock market will. Plus, you get the tax benefits, and you're able to get a 14% return. I think that's definitely something that it's enticing to a lot of people. So I think that a lot of people ask like, oh, people who aren't as familiar with it are like, okay, well, if it's so good, why isn't everyone doing it? And one thing about it is the liquidity, right? So when you're investing in an apartment, you're going to probably have a 50K minimum. Some deals are 75K or 100K minimum, so that's a barrier to entry right there. And then this has to be money that you can't pull out. It's like with a stock, you buy it, you can sell it at any time, you can liquidate it. With these apartments, you invest, you have an equity in that building, and then whenever they sell it, that's when you get your money back. So most of the deals are 3 to 5 years, but in those 3 to 5 years, your money is in that deal, so you don't have the liquidity. So because of the barriers to entry, because it's not a liquid investment, that's how you're able to achieve those higher percentages, and that's why everyone's not jumping on it. But again, I think that most investors should look at their portfolio, and they should see, okay, if my net worth is 500K, maybe I need to have access to 200K. But that 300K that I don't need to be liquid, I should expect a higher return for that. Otherwise, you're really missing the opportunity of, instead of getting that 7 or 8% return, you could really be getting a solid double-digit return.
Yeah, that makes a lot of sense. You describing the barrier to entry, and why is not everyone doing this, right?
Yeah, absolutely. So that's what's led me to go towards apartments, is finding a team of experts that do this all the time. They've got all the right systems in place already, and typically just the numbers on bigger deals work. So like my parents have a house that we grew up in North Austin. It's a rental property now, and it's a terrible rental. So they bought it back in the 90s for like 180K. It's appreciated a ton, so it's worth like 700K now. They're only getting about $2,700 a month in rent. As I said earlier, I look for a 1% rule, so that's what, like a 0.3%. So they're basically breaking even. So while it has appreciated well, we're looking to actually sell that this summer, and I'm trying to help them do a 1031 exchange, and to take it from one single family rental that's not really performing well to maybe getting anywhere from 10 to 15 units in Dallas, where they're able to get significant cash flow from the property. So yeah, I just think bigger deals typically cash flow more. I like how they're valued based on a net operating income, not comps. And that's really what's led me to focus on trying to go bigger, do bigger deals that make more money, more predictable in how they're evaluated.
Yeah, yeah, absolutely. And for those of us who aren't too familiar, could you kind of explain um, explain what NOI is as opposed to, NOI versus comps?
Yeah, so on a single family house, what they're going to typically do is they're going to see this when the property was built. They're going to look at how many bedrooms, how many bathrooms you have. Then they're going to probably go in like a half-mile radius and see what other houses have sold in your area. And that's how they're going to value the property. So as an investor, typically you want to buy something that's 70 to 80% of what you think it's worth. Go in, do your rehab, and then that's a good way to make your margin if you're buying single family home rentals. Um, Whereas with an apartment complex, they're looking at your net operating income, which is basically all of your rental income, all of your other income. It's like if you charge for paid parking, say you have like a laundry room, there's lots of different sources of other income, minus all your operating expenses. So it doesn't include your CapEx. So it doesn't include you doing big renovations to the property. But all the things that, any kind of maintenance, any kind of make readies you have. It doesn't include your debt expenses either. So basically you take the total NOI of a property and you divide it by a market cap rate, and that gives you the valuation of the property or what someone will pay for it. So if you think, say like a 5% cap rate, if you can drive, NOI up, say $100,000, that'll be a huge increase in value of the property. And it's something that, you can easily calculate. So you can implement a business plan, increase the NOI, and immediately force appreciation in the property. It doesn't matter what the apartment complex necessarily down the street, is sold for. I mean, they do look at those things, but it's not as important. What's most important is how is that business operating? What is the net operating income, and what's the market cap rate? And that's going to give you what the value is for someone else who's going to buy it. So historically, we saw much higher cap rates. 3 or 4 years ago, we saw cap rates of 7, 8%. Now everything's compressed. So as interest rates have gone down, people are willing to pay higher prices for the same property producing the same NOI, which has driven the net operating income down. But we don't know what interest rates are going to do. If interest rates go up a little bit in the future, that could cause the cap rates to go up. So that's why when we do our underwriting, we assume cap rates are going to go up. That way, if they don't, great, then we'll exceed our projections. But if they do, we've already accounted for that. So I see a lot of people out there buying those deals that we underwrite at maybe a 5 or 6%. They might be able to make it work because they're not underwriting for their cap rate going up significantly, or maybe they're only budgeting for $3,000 per unit in rehab. Well, we're being more conservative and saying that same property might need $10,000 a door in rehab. So, but ultimately, net operating income is all of the all of your total income minus your total operating costs gets you your NOI. The higher you can get the NOI, directly impacts the value of the property. And then a big difference too is so that your CapEx doesn't affect NOI at all. So pretty much the apartment model is you go in, you put a lot of money in CapEx, and that CapEx raises the rents, or you can implement something like a water savings plan. So more, either efficient appliances for water or efficient light bulbs, things like that can decrease your expenses on a property. So anything to increase rents or decrease expenses, that's CapEx, will increase the NOI. And then you don't have the same, or you have basically lower operating expenses over time. So it's definitely a different model. Another thing too with apartments is it's usually one group of professionals selling to another group. Each group puts a large amount of CapEx in. So every 5 years or so, these properties need that large amount of CapEx. But when these groups are doing the syndication, you're never going to ask your investors for more money. Once you do your raise, everybody puts their money in. 3 to 5 years go by, everyone gets their money out, they get their return. So it doesn't make the same group of people is likely not going to put more CapEx into a property. So that's why they keep these deals keep trading every 3 to 5 years. And each group is able to make money, selling from one to the other. Where single family housing, you're making your money from selling from somebody who doesn't necessarily know what their house is worth, or isn't able to do the repairs on the property. And you're maybe going from somebody who's not super sophisticated to a savvy investor who's able to buy for less than what the market value is.
Sure, sure, absolutely. And one thing you touched on earlier, you were talking about, your parents' property in North Austin, how, they had bought it back in the 90s for a much lower price than it is now. What exactly is a 1031 exchange, and why is it important?
Yeah, definitely. It's a good question. Something I've been learning about all the details and how that'll work. Recently, talking to a 1031 expert. But basically, it's a tax code. So if my parents were to sell that same property now, because they haven't lived in it for the last 5 years at all, it basically depreciated almost the full value of the property. They'd be paying about $140,000 in capital gains. So what a 1031 is it allows you to exchange one investment property for another investment property of like kind, which even though it's single family going to multifamily, it's fine. But it allows you to basically defer your tax burden to the future. So instead of paying that 140K now, we exchange from one rental property to the other. And then if we had to sell the 10 to 12 unit, whatever property we end up with, in the future, then we would have to pay taxes from both. So, over time, your tax basis goes down as you depreciate the property. So the difference of the sales price and what your tax basis is, what you have to pay capital gains on. But if you can do a 1031, you can save a lot of money from having to pay taxes now, push that to the future, so you're able to get compound interest on your money and pay the IRS in the future versus paying them now, which can be huge. And currently today, if a parent kind of doing estate planning, passing down a property to their kids, if you keep doing 1031 after 1031, whenever you pass away, that tax burden completely disappears, and you're able to pass the property down to your kids at a stepped up basis, meaning at today's value. So that's the kind of ultimate, I wouldn't say loophole, but the ultimate advantage for if you keep doing 1031 after 1031, and then you pass that down to your kids, then you never actually have to pay tax on all of those gains over the years. Now,
Yeah,
on the contrary to that, the difficulty is when you sell your first property, you have 45 days to establish which three, it can either be three options of the replacement property. So you're selling one, you're buying the other. So you basically put all the funds to the 1031 expert, and they'll hold on to those until you buy the next property. But within 45 days, you have to establish, which properties you want to buy, and then you have to close on that property within 180 days. And if you're not able to do that, then you have to pay the regular capital gains. So the tricky part is the timing of, selling and then finding a good investment. So not, a lot of times 1031 investors will kind of be rushed and just, buy whatever they can buy to meet the timeline. Sometimes it's worth it though. Like in my parents' case, they might not have to pay 140K in taxes. So even if they're getting a decent deal, maybe not the best deal ever, as long as it cash flows and as long as they're saving that 140K, it still might make sense. Whereas another investor might look at that deal and say, oh, that price is a little too high. So, I've met some people who've done really well on 1031s. In fact, the Darwin, who's the founder of DGRE, his brother has done, I think, like something like 12 1031 since the 90s till now. He's 1031 every deal. And he took $20,000 and now has a $20 million portfolio by using 1031s. And he hasn't once had to pay the capital gains tax on that.
wow.
So he's done really well. I've talked to him some. He's the one who's inspired me that's possible and that it'll work. But yeah, it's definitely add some stress because when you sell one property, you have to establish, what property you want to buy pretty quickly.
Sure. So I guess to run it back, that was Darwin that did that with the 1031s.
So that's his brother, Charlie.
Okay.
Charles Darwin. So Darwin has been syndicating. He's been in apartments. So he's been really good at raising money from passive investors. A lot of older W-2 workers and doctors, all kinds of different people. Whereas brother has been doing it by himself and really focused on 1031. And he's done everything from bought like a avocado farm out in California and did really well on that. So different strategies. I'm probably going to follow more in Darwin's footsteps and focus on the apartments. But hey, I mean, the 1031 is a great strategy too. And you don't necessarily need a partner. You can be successful and grow without partnering as well. So I think both ways work. It just kind of depends on what your goals are, and what kind of team you want to build.
Yeah, yeah, absolutely, Ben. Well, is there anything that you haven't said thus far that you'd really just like to hammer home?
Um, you know, Ultimately, I think just finding a niche and kind of understanding, what you want to focus on, and then trying to become an expert in that niche. A lot of people get shiny object syndrome and have all these different interests. But I think yeah, just picking one niche, meeting people who are really successful within that niche, and then focusing. And then I think it also delaying your gratification. So as for other 20-year-olds out there, if you can wait till you're wealthy to drive that nice sports car versus trying to get a nice car right away, it can be huge. So
Yeah,
focus on your net worth, and try to invest as much money as you possibly can. Try to cut down on your costs, and it'll be a really big return in the future. So
yeah,
for me, I always try to stay feeling relatively not, I wouldn't say poor, but I want to keep my bank account relatively low because all my money's, as soon as I have 100K in the bank, I'm investing it in another property.
yeah,
So yeah, those are the kind of principles I've lived by. And even though I've had a full-time W-2 job, I've probably also been full-time in real estate. So just been kind of hustling, grinding, knowing that my future, I'll have the freedom that, I can kind of do whatever I want to do. Give me my family the freedom to travel the world, and not necessarily have to worry about a W-2 job. So.
yeah, yeah, absolutely, Ben. Well said. Maybe someone's watching. Where can we find you?
Yeah, so LinkedIn, Ben Mandelstein, or Facebook, I'm active as well. For anyone who's in a market like Austin or California, where it's really hard to find good cash flowing deals, feel free to reach out. And like I said, I've partnered with multiple people out of state. But like I said, the syndication I think is a really solid model. The group I'm working with, Darwin, they've done very well historically. That's kind of why I've chosen to work with them. So I'll be looking for my first apartment deal. But like I said, they're raising money right now for a deal in Waco. So if you want, at least, double digit returns, you want a professional, really good team of people operating, feel free to reach out to me and I can connect you to Darwin's team. We'd definitely be happy to have any of you guys passive investors invest with us. So.
Yeah, yeah, absolutely, Ben. Well, thank you so much for coming on. I've learned a bit, not only about you, but a bit about the deals you've done, what you're doing now, and what you're looking to do in the future. So you've been a wonderful guest. Thanks.
Thanks, Aaron. Yeah, appreciate you having me. So it's always cool to see other successful Longhorns. So keep at it. And yeah, it was an awesome podcast. So thanks for the invite.
Absolutely. Thanks a lot, Ben. We'll talk to you soon.
Sounds good. Talk to you later. Bye.